as the markets go higher, and granted, this isn't for crypto, but there's a wealth effect that adds to inflation, right? So, I always tell people this is they say, well, why is if the stock market goes up, does it potentially add to inflation? And the concept is that if you look at your 401k and it was 200,000 yesterday, and let's just say it's 400,000 today, and you were kind of thinking about a new car or a new TV, you're much more likely to say, yeah, let me go buy that new car, new TV, because look at my 401k. It's up massively. And
Mhm.
so that's the reason why the Fed is more focused on the stock market and wanting it to come down. But right now they've lost that credibility.
The U.S. Central Bank opted to pause its tightening campaign at last week's Federal Open Market Committee meeting, but signaled 2 additional rate increases this year. Fed Chair Jay Powell is due to appear before the House Financial Services Committee to give his semi-annual testimony, which will be watched closely for clues on his thinking about interest rates. Tuesday's U.S. weakness followed a week in which the S&P had reached a technical bull market, defined as a 20% rally from its low, prompting debate about the sustainability of the gains, which have been heavily led by advances for artificial intelligence-related stocks. Thomas Matthews, the senior markets economist at Capital Economics, said growing enthusiasm about AI will not be enough to stop the S&P 500 from declining if the U.S. economy falls into recession later this year. Gareth Soloway shares his views regarding the stock market, pointing out that the Fed is trying its best to bring the stock market down as high levels point towards inflation, but he added that the Fed has lost credibility. Soloway also talks about the king digital asset Bitcoin and compares it to gold while comparing Ether to silver. He also talks about the rising credit card debts, interest rate hikes, and unemployment rate. As you watch, endeavor to give us a like, subscribe, and drop your comments.
From my perspective, is definitely Bitcoin's on that track to be that digital gold asset, and I think Ethereum is likely the silver kind of the crypto markets. And what's interesting about gold and silver, right? So gold is your pure play, where it's just a store of safety, inflation hedge, all that kind of stuff. And then Ethereum is like silver in that silver is more volatile than gold. So Bitcoin is less volatile than and Ethereum is more volatile than Bitcoin. But also Ethereum has a use case, right? Bitcoin, there's you
Right.
don't really see a lot of stuff being built on top of that. So I think those my guess is, and again, I could be wrong here, but my guess is the future is those two make up probably 80% plus of the overall market. And then you might have some of these other smaller coins kind of carving out their niches, but it's hard to know. I mean, and now we have the biggest news in the last week was that BlackRock filed for ETF, right? And
Right.
so the question is, and I think the big question, we saw a little rally in crypto because of this, is does this mean because there's such a mega financial institution that they talked to Gary Gensler, and Gary Gensler might have said, hey, listen, yeah, Bitcoin isn't a security, so we're going to give you, the biggest financial institution, the green light. Because I think if you look at the stats, right, BlackRock's filed for like 75 ETFs. They've gotten approved on 74 of them, right? So they obviously have this kind of ability to kind of say, okay, if we're going to do this, the probabilities of success are very high. Yet we've seen the SEC reject time and time again a spot ETF. So it's kind of interesting here. What I do want to show here, and I'm going to flip over to my screen here, is I do want to go over that gold chart. A lot of people have been asking me, do you still see gold breaking out this year? We've kind of see gold languishing here. And the one thing I would just point to, and this brings us over to the stock market side of things, is that gold is stalling here. But what we're seeing is there's a massive inflow of bullishness into the market. So in general, when you see stocks like Nvidia going to new all-time highs and things, in general, you see gold falling more because it's a safety hedge, right? It's people saying, hey, I don't want to be in gold because I want to be in risk assets where I'm going to make more than a few percent on a yearly basis, which is more along the lines of what you expect from gold. And so I find it fascinating, and it's the same sort of thought process that I had when we were trading at the lows on gold in 2022 and going back to 2021, and the markets were at their highs. You weren't seeing, and by the way, this is when the Fed was raising most aggressively, and generally gold reacts very negatively to hikes in interest rates. Gold was not breaking down outside of this kind of choppiness. It got to this low end and then started to rally back. So for me, when I look at the price action in gold, gold is staying stable while you're seeing risk assets aside from crypto rallying substantially. I think the NASDAQ now is year to date up something like 38%. I mean, a massive, massive move. And so to me, this is a very bullish sign for gold. It's telling me that you have sellers that are moving out of gold to move into risk assets, but there's definitely buyers there, thus price is not falling.
Soloway also pointed out that there's trouble ahead in the commercial real estate space, especially in the office sector, which has been plagued by the shift to remote work. In the first quarter of this year, the commercial real estate loan delinquency rate increased by 12 basis points to 0.77%. That's the highest it's been since the third quarter of 2021, when it reached 0.83%, according to a new report published by S&P Global Market Intelligence. That's a bigger deal than it might first appear. He adds that credit card debts are soaring with high unemployment rates and uncertainty about the Fed's intentions to hike rates. Let's get back into the video as Soloway talks about it in detail.
We hear that they've raised interest rates by X percent, which has been huge. I mean, the velocity of the raise, I think, is the shocking part. From going from a quarter basis point to where we are above 5% is just massive. But then you look at how much excess liquidity there was in the system because of COVID. And then you look at, all right, wages have increased substantially, so people have more money. I do think, like you're saying, there are cracks emerging, right? So last Monday when we did the no-shill zone, we talked about the jobless claims from the previous week being 266,000. And that was the biggest jump since 2021 in people filing for unemployment. And what I was saying is last week to really watch the next number, because sometimes you get these outliers, the data changes this calculation and it changes the numbers. But what we saw last week was 262,000 filing for unemployment, just 4,000 people difference. And to me, that's now saying, okay, it's probably not an outlier. You're beginning to see the effects of people getting laid off and filing for unemployment. So that would be one thing. A couple other things I'm seeing here. U.S. delinquency rates on credit cards are now rising at their fastest pace since 2008, right? So now it's not at the level, right? So the rate of change is rising, right? That's what it's equal to, but you're not at those levels. In fact, I'm going to show my screen here. This is a David Lynn, courtesy of David Lynn. And let me just throw mine in here. So here's his tweet. And I by the way, if you don't follow him, he's awesome at his data. He's a great interviewer and so forth. So definitely look to follow him. But U.S. delinquency rates on credit cards now rising at their fastest pace since 2008, although still nowhere near 2008 levels. So here you have the drive higher is essentially at that same rate, but you're still far below. So what that tells me is that people are still able to do their thing, even though the delinquencies are rising substantially. And then this one's kind of interesting as well, which says credit card debt now at all-time highs. And the reason why this is important in terms of credit card debt is because at all-time highs, if people stop paying their credit cards, it's a bigger deal to banks, right? So, if you don't pay your credit card and you owe $10 to the bank, okay. But if you own $1,000 and there's 1 million people that owe 1,000, now it becomes a bigger issue. And being at all-time highs is definitely unsustainable in the long run. The other thing too to just mention as I flip back to charts is that I also read that bankruptcies are now at their highest level since, I believe, 2011. Now, it's not at 2008, 2009 levels, but you're seeing again this shift. So for me, at least as an investor in stocks, in gold, in crypto, it's kind of the yellow light. You're not seeing the red flashing like, holy cow, we're going down with the ship, but you're seeing like, okay, there is a change going on here. And then the bigger question to bring back too is whether or not does inflation go back to 2% or under for the Fed, or do they get themselves in a pickle where we stick at 3% and it makes it very hard for them to bail us out whenever that big downturn comes?
The central bank raised interest rates 10 times since last year, the fastest pace of tightening since the early 1980s, and that has caused credit card rates to hit an all-time high. Even though the Fed has hit the pause button on its rate hiking campaign, the cumulative effect is significant, said Ted Rossman, senior industry analyst at Bankrate. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark. As the federal funds rate rose, the prime rate did as well, and credit card rates followed suit. The average credit card now charges a record 20.69%, nearly 5 percentage points higher than at the beginning of last year, according to Rossman. While the skip means interest rates may not rise again this month, the high credit card interest rates consumers are currently seeing are going nowhere anytime soon, said Michel Ranieri, vice president and head of U.S. research and consulting at TransUnion. Sky-high APRs make credit cards one of the most expensive ways to borrow money from month to month, and yet many Americans continue to take on ever-increasing amounts of debt. While balances are higher, nearly half of credit card holders carry credit card debt from month to month, according to a Bankrate report. Paying down high-cost, variable-rate debt is an urgent priority for households, said Greg McBride, chief financial analyst at Bankrate. Soloway also believes that the recent BlackRock move may be very bullish for crypto, as it caused a bullish rally for Bitcoin days after the ETF spots were filed. Do you think the markets are now really indifferent to the Fed's decisions? Let us know what you think in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.